I'm going to dive in here today. We're talking about multifamily investing overview, what to expect in 2024. That might be a little bit of a deceiving topic just because I recently came across this really cool Q3 of 2023 report from CoStar. CoStar is one of the many great sources for commercial real estate, specifically multifamily. I see someone's here actually from Austin, Texas in the chat box. I live in Austin, Texas myself. That's where I'm recording this video. That's super cool to see. So I was just talking about where this document, these charts that I found online that I wanted to share and discuss through. That's what intrigued me to do a webinar on this. So these are a few slides that I pulled from CoStar, as you can see down here. I believe this is public information. Again, this is a report, a Q3 2023 report that they just released back in September. It shows the trends over the past 15 years or so and the future for the next 3 or 4 years. I think it's a great way to show, we're closing out the year here, 2023, and I think 2024 there's a lot of question marks potentially that people might have within the multifamily world. It's been a unique year to say the least, and I think 2024 will not be a normal year. So let's just dive right into it. So the topics that I said we were going to discuss are apartment deliveries, net absorption, vacancy rate and rent growth, sales volume, and cap rates. If none of these make sense to you, I highly encourage you to look them up as we're talking here. I'm not going to dive exactly into the meanings of all these, as they're relatively self-explanatory, but if not, just write a question, happy to answer. So as we talk through this, note that some of these slides are talking about the multifamily sector of the United States as a whole. And I tried to grab some slides that tailor to your more institutional quality, your 4 and 5 star apartment complexes. So for instance, this is talking about the United States as a whole, including all multifamily properties, whether that's brand new, whether that is older assets, so be it. So let's dive right in here. This might be a little complicated at first glance, but really there's 3 things here that are important. You have net absorption, net deliveries, and a vacancy. So net deliveries, that's just your apartments that are being delivered, that are being developed, they're released, they're completed, and then they need to lease up. That's just a delivery. Net absorption is how fast those units get leased up and absorbed into the market, essentially. And a vacancy rate, that's just units that are sitting there vacant. So talking in the past here, you have the crash of 2008, 2009, I guess a little bit of 2007. You see that apartment deliveries really slowed down. A lot of people stopped delivering units. Getting loans back then was very complicated, so people stopped developing as much. And a lot of people were still moving into apartments, leasing apartments, so there was a higher absorption rate. We had a great run from 2012 to 2022, I would say, where majority of the years or the quarters, there was more absorption than deliveries. But as your loans got super cheap, a lot of people started to develop, a lot of units started to come online, and you could see that here. So there's just a lot of deliveries in the United States all around. And we're going to talk about specific markets as well. But you had a lot of deliveries, and in 2022, late 2022, in 2023, a lot of people stopped moving around. They were complacent. They were happy where they were staying, and just a lot less people moving, call it post-COVID era, from different markets. So you have vacancy starting to increase, and that's kind of where we are at in today's market, right? We're at a slow period for leasing in 2023 in the holiday season. But during that time, you have a lot of units, especially here in Austin, where I'm calling you from, that are being delivered, and they're struggling to lease up. They're offering higher specials or concessions. They are decreasing rent slowly. They're doing all these things to make sure that their apartments start to get leased up. And we're going to see that continue through 2024. And we know that, CoStar knows that, is because a lot of this is public data. You can pull records of permitting, um, basically out till 2027 to see who's going to be developing or who's rezoning land, etc. So we already have seen a decline in permitting and deliveries coming in 2024. So that's starting to slow down. Main reason being the debt. It's just becoming more expensive. Um, and net absorption or people moving and absorbing those units is slowly going to start to increase or steady throughout the next couple of years. At least that's what's going to happen in CoStar's perspective. And eventually, in about 2 years' time, you're going to see that stabilize. You're going to see the net delivery and net absorption equal each other. And that's when vacancy will start to stagnate / decrease again. But over the next, call it, couple of months, maybe a year or so, you're going to see higher vacancy rates. You're going to see rents not increase as much as we've seen during COVID, which you could see here. So vacancy shot down abruptly, increasing rents, and that's starting to crawl back slowly. If there's no questions on this, I'm going to move on to the next slide, but a lot of them are intertwined with each other. So I'm just going to build on top of what we're talking about. Okay, next slide. So top net deliveries. These are talking about the largest MSAs. Obviously, we're excluding some markets that obviously have some development that just aren't as big to be talking about. But in the perspective of this, you might think that Dallas has a big issue, right? They're going to deliver a lot of units, and it's going to be hard for them to absorb these units. But in reality, since Dallas is such a large market, the percent of the market share is really not that much of 28,000 units coming online. This is in the last 4 quarters, by the way. So call it Q4 of 2022 to Q3 of 2020, excuse me, of 2022 to 2023. I think this is interesting. Austin's sitting right here. This is a market that is notoriously known for having a lot of units coming online, as well as Orlando and Nashville. But there's other markets that are just outperforming them in the sense of just sheer amount of apartments that are being developed. I think this next slide puts it into a little bit better perspective. Whoops. Here we go. So this is actually net deliveries as a share of inventory, right? So who has the most units coming online in a percentage of the entire market itself? And these are the cities that might not struggle, but might have a little bit longer periods of stabilization or absorption. So you may have heard Nashville, it's Crane City. You go there, you see Crane everywhere. A lot of their developments are actually happening within downtown area. But this is I guess compared to what I was saying with Dallas, these are smaller markets that are having a lot of units come online in a short amount of time, and you might see a little bit slower rent growth in these markets. So like I mentioned, Austin's up here, Orlando, Salt Lake City. A lot of people don't really think of Salt Lake City as a lot of development or whatnot, but they do have a lot. Jacksonville, Nashville, and you'll find Dallas all the way down here. So they have less than 5% of the entire market, even though they have the most units coming online. So just something to think about. Not all of these charts paint the entire picture. I think, excuse me, I'm going too fast. I think this just paints a better picture of what markets might struggle or have the most units coming online as a percentage of inventory. If that's a little bit confusing, don't hesitate to ask questions. But this is not going to, in some of these markets, this isn't going to slow down. I know Austin just because I live here. A lot of units are actually coming on next year. So it's just something to keep an eye on as we continue to invest, right? As a multifamily investor, or if you're looking at syndication firms of where they're looking to buy projects. Okay, next slide. Most units under construction. So we just talked about deliveries, right? What's going to be delivered or what has been delivered in the past 4 quarters. Now this is future looking forward in the next, I think this is the next year or so. or under construction, excuse me. This is literally what is under construction, what has plans, what is being developed currently. You could see that Dallas and New York flipped. Austin's still up there. I just mentioned next year there's going to be a lot more coming online. You have places like Orlando where there's a lot less, Nashville a lot less. So a lot of their apartments have already been delivered, which is good news. They're going to start being absorbed. And I also have total net absorption of these under construction. So, or excuse me, as a whole, net absorption. So you can basically tell that a lot of people are moving to New York. They can handle all of that development. Same here as Austin. You have a lot of jobs in those two markets. This is New York City, by the way. So they're going to be just fine. They can handle the number of units that are being delivered as well as units under construction. Whereas some other markets to keep an eye on are Orlando, right? We saw that they had a lot of deliveries and under construction. Same with Nashville, a lot of deliveries right now. And their absorption is just slower, right? They still have great jobs. They have the infrastructure to take these people in, but it's just they're going to take a longer time for these new units to fill up compared to in Austin, compared to in New York. So this just, I think, paints a bigger picture of potential rent growth in the years to come. This is also a lagged indicator, right? Net absorption is a share of inventory. So we just talked about New York having the largest net absorption, but that doesn't necessarily they're doing the best when it comes to filling up their apartments. Austin, Nashville, those two are. You have so many people moving in compared to larger markets like Dallas and New York. They're leasing up faster. They're smaller markets where they can handle it. So it balances out. But there's clearly some negative net absorption where people are moving out. Where someone just said, what about geography or migration? Yeah, people are leaving these cities and moving to cities like you'll notice a lot of these are in the Southeast. Raleigh, Jacksonville, Miami, Boston, not Orlando, whatever, Charlotte. So a lot of these people are moving out of places like Vegas, like Baltimore, Oklahoma City, Memphis, Detroit, these cities where you're not, the job growth's just not there. People want to get out of the cold. People don't like the politics, whatever it may be. People are leaving and coming into these markets. And you can see Austin is probably seeing the biggest migration of them all, including myself. Okay, moving on. So this is a chart that only is tailored towards your nicer assets, your higher institutional quality assets, whether it's a high rise, whether it's a new development, whether it is elevators, whatever it may be. This isn't your 1960, 1970 product of 10 to 30 units. This is your 300 unit apartment complex that is 20 and 10 and newer. And this is what PassiveInvesting.com, the company that I work for, this is what we invest. So I found it to be interesting just to talk about this as a whole. So very similar to the first slide we just saw, excuse me. Deliveries slowed down after the crisis of 2007, 2008, and that's ramped up. We've had a great run from 2012 to 2022. You've had high absorption. You've had deliveries, apartments being delivered still pretty consistently at an increasing rate, and we're going to see again that drop off. We're going to see people still looking to move into these nicer, call it renting by choice asset class. And eventually in a couple of years time, it looks like in early 2026, well, that's weird to say, in early 2026, we're going to see those cross, right? You're going to see net absorption outpace net deliveries, where you'll probably see vacancy rate come down. You'll probably see market rents increase, things of that. You'll have less specials, less concessions. So just something to keep an eye on. I think this is pretty consistent with not only 4 and 5 star multifamily, but 2, 3. In every, this is again the United States as a whole. So next year, 2024, you're going to see a lot of deliveries. You're going to see a lot of new product come online throughout the United States, as we had just seen, a lot in the Southeast, and not as much net absorption. So what's going to happen? You're going to see rent growth probably come to a stall. It's probably going to be in the low single digits and even some places in the negatives. You're going to see vacancy rates increase. I'd say we're at a point where in the past couple of years, a lot of properties have sat at 94, 95%. And I'd say right now they're closer to 90, 92%. And I think that's going to hold firm for at least CoStar believes that's going to hold steady for the next couple of years here, or at least quarters. So very, it's definitely really interesting stuff that we need to keep an eye on as we continue, as a member of the acquisitions team, something that we put a lot of weight on when we're looking at specific markets and even specific submarkets. Okay, now this leads to rent growth. This is something I've been referencing through these charts above. We have seen, again, over the past 10 years, really steady growth when it comes to rent growth. We've seen over the past 2 years, double-digit rent growth numbers. And in even some cities, Miami, Orlando, we've seen 20, 30, 40% rent increases. I think that's done. I know that's done. We've seen that decline over the past 4 quarters, 3 quarters, and I don't think it's coming back anytime soon. We're going to have some normalcy over the next 4 or 5 years of low single-digit rent growth, just like it's been over the past 10 plus years, unless something catastrophic happens like here, but no one can predict that. But over the next year and a half, it's going to be slow to increase, as we've seen with these deliveries, right? As the number of units constructed slowly declines, your market rent will slowly increase, just given less competition, less places for people to choose, etc. I'm going to take a breath here. I see there's some questions coming in. I'm trying to get to them. Okay, looks like I answered one of them. Perfect. Let's move on. Excuse me. This is the chart we just did. Okay, skipping around here too fast. Perfect. Rent growth. This is just another way of looking at it, right? We've talked about the different asset classes with regards to stars. That's how CoStar rates them. Below 1 and 2 stars just being your older vintage, smaller assets in less desirable locations. 3 stars being that middle of the road. Call it B asset. 4 and 5 just being your AA locations / properties. They're pretty consistent with each other. During COVID, you've seen a huge spike in the 4 and 5 star asset classes, and we've seen a harsher decline in those markets just because there's more product of that coming online as opposed to 3 stars, which is staying the same, right? Your new deliveries are typically 4 or 5 stars. So again, they're going to crawl back in 2024. It's just going to take a little bit of time, and then we're going to, at least CoStar predicts that we're going to be at around 3-4% over the following couple of years, which has been normal, as you can see, from 2012 to 2021, right? When things changed. This is an interesting slide. This gives a perspective of what's happening in my world with sales and transactions. Over 2019, it was pretty normal. 2020, COVID hit. No one really knew what was going to happen, but then everyone bounced back and realized it's a great time to invest. People moved around. NOIs increased significantly. Everyone was excited to sell and to buy. So you saw a lot of transactions happen. And that fell off as soon as debt started to increase, and that's ever so with the instability and the volatility in the Fed funds and really knowing what's going to happen next. There's been such little transaction happening. You're seeing all the institutional buyers, your big names, your REITs sitting on the sidelines waiting. They're not going to be the ones that are trying to predict the future. They're usually the last ones to come back into the market once it gets settled again. So a lot of this is your all cash buyers, or your people that need to fill quotas, or your private equity firms such as passiveinvesting.com that are being patient but trying to buy the right deals where there's still great rent growth in specific markets, where there's lower vacancy, things of that nature. So I don't think CoStar came out with a forecast, but this has been a year of patience. There's a lot of people that haven't bought a property, including ourselves, in the multifamily sector, of course. But we've been patient, and I've talked to a lot of other operators and acquisition folks. They're in the same boat. They're excited to buy, but they're not going to buy something that doesn't make sense with the current debt environment. So just something to keep an eye on as well. Okay, I'm running out of time here. I'm going to try to wrap up, but I think I have 2 more slides. Oops. Okay. Okay, pricing. So you saw sales volume decrease over the past couple months, or year or so, and what's it called? Market pricing has decreased as well, right? Your cost of capital, your cost of getting a loan is increased, which is just crushing pricing. People are not able to afford what they once were able to afford during COVID when debt was so inexpensive. So you're seeing, again, this is United States as a whole. This is all of the sales. So try not to pay attention too much to these numbers here, more so the annual price growth as well as the time frame. So you're seeing values decrease, and they over, let's see, since call it Q1 of 2022 till Q3 of 2023, you're seeing pricing decrease at a steady pace. We're probably going to see that continue until 2025-ish, or really when the Fed announces they're going to make some actual cuts and it's confirmed and we start seeing it, is probably when pricing will start to increase. And there's other reasons. It's not just debt. You have increasing property taxes. Your counties are just catching up from 2021 and 2022 transactions, and your assessed valuations have increased significantly, causing your tax bills to increase 20, 30, 40% in some places. As well as your insurance rates, right? Like here in Texas, we've seen a couple of events. Last year in Austin, we had a freeze. I think 2 years ago in Houston, they had Harvey, which did some damage, and a lot of carriers left. So insurance in Texas has skyrocketed. So a few things like this that are affecting market pricing as well. But that'll eventually bounce back, hopefully, as things start to turn around, as debt markets start to calm down slightly. We will see a lot more transactions at a lot more healthy market pricing. Okay, cap rates. I hope this isn't all doom and gloom. I hope you guys aren't too worried what's to come. I think we're already seeing the declines in a lot of this that we're talking about. I don't see it slowing down just yet. And that's what a lot of these forecasts are showing. Just a 2024 year of of decreased pricing and a little bit more expensive debt. But that will normalize, as we've seen in a lot of these forecasts. That will start to slowly come back. It's just going to take a little bit of time. And this doesn't mean that things can't happen. You're still seeing sales volume. You're still seeing people transact and buying assets that make sense in today's world. It's just not at the volume that it once was. And you are still seeing rent growth. I have friends here in Austin that still are seeing price increases. I was just talking to a coworker who's in Wilmington. They're increasing prices. So it's not all doom and gloom. You're still seeing a healthy fundamentals. You're still seeing rent growth. It's just not at the pace that we had seen it, which I think is a given. We all knew this uh, this time period of just insane, unprecedented growth was eventually going to normalize and start to decline. And that's just where we're at now. That being said, this is my last slide here. It's cap rates. I think it's highly correlated to your pricing, but cap rates have come down, obviously, over COVID era. They've compressed and they're starting to expand slightly. When market prices comes down, we're expecting cap rates to expand, to increase. This is the market as a whole, so disregard these numbers here. But in your Class A product and product that we're looking at, it used to be 4.5%, and now it's 5.5% in some markets, maybe even 6. So, but that'll normalize again. That'll come back down. It'll just take some time. Ooh, that was a long-winded 30 minutes. I'm going to take a pause for a second. I'm going to stop sharing. I want to go through some of these questions that you guys might have. Okay, I see one here in the chat box. Have you considered purchasing heavier rehab properties now until the new property price drops in late 2024? That's a great question. We have definitely considered looking at older properties that have quote unquote meat on the bone, where they have a lot of classic units and you can potentially renovate those units and generate a higher NOI, etc. Instead of just natural rent growth, you're creating, I call it sweat equity of sorts, or just yes, we've considered it. We've expanded our buy criteria to older assets. However, it's a little bit more tricky. For instance, say we were buying in Houston a brand new asset versus a 1990s build. It's a lot more challenging to buy a 1990s build right now when it comes to things like getting the right debt, getting the right property insurance. There's just a lot more uncertainty in it. As an owner operator as well, there's just more risk to it. So when there's more risk, there's more reward. So it's definitely something we've considered, but not something we've acted on quite yet. But that doesn't mean that down the line we won't buy an older asset. Okay, I'm gonna look at the question and answer. How can one get ahead of the REITs? I'm not sure what you mean by that, Bob. Oh, you mean in just buying in an operating perspective? Well, a lot of the REITs are on the sidelines when it comes to buying new assets right now. A lot of them are actually selling, like Blackstone, B REIT is selling a lot of product in the past 6 to 12 months. They've sold a lot of assets. So to get ahead of them is to get into the game now. I think buying right now gives you have a lot less competition. You have a lot of the big buyers on the sidelines. You're competing against other private equity firms that are looking at the same stats that we're looking at. But if you believe in a project, you believe in an asset, you believe in a specific market even, you can still definitely have a successful acquisition as well as operation and potentially exit. So I do think it is a good time to buy. I think this is a buyer's market. I don't think a lot of sellers during negotiations have a lot of power per se. I think if a buyer and seller come to an agreement, let's see. I mean, the seller is happy to have someone to buy their asset, and I think they're a lot more willing to work with buyers right now. So I hope that answers your question. What is your recommendation for new investors with buying older properties in your area or their area, 2-hour radius? I think buying in your area is a great way to get started. It's just, you could be a lot more hands-on. Recommendation, I think you have already started. You're joining a webinar talking about the environment as a whole. Meeting with local people is a great way to get connected with potential sellers or even buyers. A lot of people are looking for equity nowadays, so there's a whole plethora of ways to get involved as a new investor. So whether it's invest in a syndication and become a limited partner or do it yourself, I think just getting involved, getting to meet people and just starting, just doing it. Okay, I'm going to end there. Thank you all for joining. I hope this was super helpful. I'm happy that you all joined here. And if you're watching this on recording, thank you for joining. So, okay, thank you.